You know that thing where you get an amazing pair of shoes at a really great price and want to tell everyone about it? Yeah, so do we. Here at Designer Shoe Warehouse, we'll give you something to brag about, like the latest styles from brands you love, or the trends everyone's obsessing over, or shoes that make you feel like, well, you. So go ahead, show off a little. Find shoes that get you at prices that get your budget. Head to your DSW store or DSW.com today. DSW, let us surprise you.
Hey, want a cookie? Oh, I know you just ate, so you're craving something a little sweet. Besides, one cookie isn't gonna kill you. How about half? Just a bite? Bite it. Bite it. Bite it.
Food noise isn't fair, but Mochi Health is. Your affordable GLP-1 source that puts you on a path to successful weight loss by quieting food noise.
Bite it.
Shh. Learn more at joinmochi.com. Mochi members have access to licensed physicians and nutritionists. Results may vary.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to review how the market is performing, and we're also going to go over an old adage: sell in May and go away. Before we jump into the potential of May, let's go ahead and take a look at what happened in April. April has traditionally been an extremely strong month for the stock market. The Dow Jones Index has seen a gain on average of 1.9% since 1950. That is according to the Stock Traders Almanac. We have reviewed the Dow Jones several times on this podcast, but just to give you a refresher, this is an index or a group of stocks that holds 30 American publicly traded companies. The grouping of 30 companies are blue chip stocks. Blue chip stocks are stocks that have stood the test of time. Some examples of blue chip stocks are Johnson & Johnson and Disney. The Dow Jones Index is a price-weighted index that is different than the S&P 500 and the NASDAQ that are all market cap weighted. In other words, the movement that the Dow Jones is tracking is related to the change in price of the stocks that the index holds. And the market capitalization weighted index like the S&P 500 or the NASDAQ is measuring a company's size. The size is calculated by the shares that are outstanding from each individual company that the index holds, along with the price of those shares. I do realize that all of this can be very confusing, most especially if you're listening to this for the first time, but I promise the more that you listen, the more it will start to make sense. All in all, the most simplest way to look at this is that the Dow Jones is measuring the change in price, and the S&P 500 and the NASDAQ are measuring the change in company growth. Historically, April is a strong month for the stock market overall. However, the Dow Jones Index really performs when it comes to April. As I mentioned earlier, the average gain for the Dow Jones is 1.9% since 1950. So let's take a look to see how these three indexes performed in the month of April. The Dow came down 4.4%. The S&P 500 came down 3.9%, and the NASDAQ came down 4.32%. Those are definitely some pretty steep losses to have. However, when we look at the stock market year to date, it has truly been on a tear. Typically, we can expect for the market to grow anywhere from 8% to 10% in an entire year when we're looking at the S&P 500 specifically. And we were seeing a 10% growth in just the first quarter. So that is very unrealistic growth patterns to continue. I think that this pullback is definitely merited. One of the biggest catalysts to this drop that we've seen in the market is definitely the data that is coming in for inflation. We are not necessarily seeing inflation at the place where we would like to see inflation, which is at 2%. We are still seeing inflation grow month over month. And of course, this is concerning for several reasons. The reason why it's the most concerning for the stock market specifically is because the stock market doesn't want to see higher interest rates or interest rates sustaining this height for any longer. The stock market wants to see interest rates come down because when interest rates come down, there is more liquidity in the market. There is more money in the market. More money in the market in general means that more money will head towards the stock market specifically. And that money can show up in the stock market in numerous ways. One of those ways for the money to show up in the stock market is by being a consumer in a publicly traded company. If you have more cash, you're more likely to buy discretionary items from a publicly traded company. Eventually, that revenue, that money you spent in the publicly traded company, then will get reported to the public as earnings, as revenue, and so that increases the value of the company. Or in another way, which is less common, that liquidity actually gets put into purchasing stocks, adding more stocks to your portfolio, which increases the stock price. Either way, both of these ways will increase the stock price of a company because you are either investing directly in the company or you are purchasing their products. Therefore, making the company more valuable. The goal here is that you move from being not only a consumer, but also an owner. Throughout my investing journey, I have always been hyper curious about these trends and patterns that we have seen taking place in the market for decades. For me, there has to be some sort of logical explanation on the trends and patterns. I can't just rest on the knowing of the trend. I want to really understand why the trend is taking place. And so if we look at the month of April traditionally being one of the strongest months in the market, then let's discuss what we know about April. And we know a couple of things about April. The first thing is that it is the first month in the second quarter. The second thing that we know about April is that earnings are released from the first quarter. And one thing we know about the stock market is that we can count on when earnings are released for the stock market to either move up or move down. And so for me, it now becomes obvious that in the first quarter of the year, for whatever reason, we are strong consumers. And in being strong consumers, we inevitably make the market strong in the month of April because all our consumption is now being reported in the month of April. I'm starting to wonder if April of 2024 is a canary in a coal mine, letting us know that there is a bigger issue at hand when we start to look at the consumer. When I look at the market overall, as I already mentioned, year to date, we've had incredible growth. But I just can't shake the feeling that April coming down this far in 1 month is trying to tell us something. We're going to take a short break, and when we get back, we are going to talk about the old May adage, sell in May and go away. Investies, Every single week, I head over to Apple Podcasts and I check to see if you have rated and reviewed the podcast. And some of you have. And I want to tell you all, thank you so much. I see you and I read you. Some of you haven't though, and I get it. We're super busy. You've got things to do. You're picking up the kids. You've got to go to work, all the things. I'm busy too. I just want to ask you to please, if you can take some time, head over to Apple Podcasts, rate and review us. This helps to push our content further into the algorithm so more folks can discover us. There are very limited voices that are speaking on finance in this way, like myself as a Latina, and I just want to let Apple Podcasts know that our voices matter. And a sure way to do that is by you heading over to the app, giving us a rating, and writing a review. Every single time you write a review, I jump up for joy. So, keep me jumping over here. And I understand you're busy. Just please take 5 minutes and do that for me, please. And thank you.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Growing a successful business has never been easy. But whether you're navigating a complex industry or trying to reinvent one, our breadth of banking experts are here to collaborate on market-proven solutions. At KeyBank, we're built to grow with your changing needs because we're not just here for the business you are now, we're here for the business you'll become. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
And we're back. The old adage, sell in May and go away, became famous in the 1930s from the Stock Trader's Almanac, and it was based on the historical pattern that stocks tend to underperform from the month of May to October compared to all the other months in the year. If we start to look at this from a strategy perspective, given that traditionally April is always a high-performing month, then it would make sense for traders to cash out on the gains that they had from the start of the year all the way to the end of April, and then come back after October. However, we are not traders. We are long-term investors. It's important for us to understand that these patterns are so much more important to someone that is trading the market versus someone that is looking to build generational wealth, that is looking to build long-term growth. The market is continuously going to move up. It's going to move down. In the meantime, we just need to stay patient and be disciplined and continue to invest into the market. So, sell in May and go away? Absolutely not. Stay in May and buy into June, July, August, and September. You know why? Because if the market tends to underperform, then these are the moments where we have opportunities to buy into our investments at a lower price. This is not financial advice. This is for entertainment purposes only. Always do your proper research when making an investment. Last thing I want to share with you is that we did hear from Fed Chair Powell at the time of this recording, and he has announced that he is not increasing or decreasing interest rates, we are going to hold steady at this rate for a longer period until he has solid confirmation that inflation is coming down. The market reacted very positive to what he was saying briefly, and then as the stock market closed, we saw the reaction reverse, meaning we saw the stock market come down and react negatively. It is May 1st today, and the market closed at negative 0.32. I just want to remind you that the market is always going to be volatile, that the intention of this podcast is to solely educate you and help you move through these emotions and better understand what the market is actually reacting to. As long-term investors, it is so important for us to look at the long-term picture versus the movements that are happening on a day-to-day basis. However, I do believe that understanding the movements on a day-to-day basis can be very beneficial in understanding the stock market overall. And when you're confident, you make better decisions. And the only way to gain confidence is through experience. And on these day-to-day movements, although we shouldn't give them too much weight, they still matter because we're students and we're learning about the process. All right, you all, I will see you next week. Investies is a Cosmic Standard and In Lose We Trust production. I'm your host, Linda Garcia. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.